Well, welcome back, ladies. We're going to go through the last part of the course companion 5A on perfect competition in perfectly competitive markets and monopoly. And what we're going to look at today is number one, we're going to look at an exam-based question on monopolistic competition, which is what we looked at last time round, the last narrated PowerPoint. And then we're also going to look at barriers to entry and barriers to exit, which is something that we've talked about in both perfectly competitive and monopolistically competitive markets. So it's something that we need to go through in a little bit more detail to make sure you're completely comfortable with the whole process. But before we do that, we're going to take a look at a typical exam-based question. This one comes from paper 1, 2017, and it was question 9, and it was a 15-mark question. So the question in this case, if you remember when we've looked at essays, like 15 markers and 25 markers, on paper 1 you get 2 essay questions and you have to choose 2 of them together, one a 15 marker, one a 25 marker. This one was a 15 marker, and this essay was based on the content which is listed here. So roughly 18 billion is forecast to be spent in the UK on advertising in 2017. Much of this will be spent by monopolistically competitive firms or oligopolies seeking to differentiate the products they sell to consumers. So that gives you some context for answering this 15-mark question. Okay, and the question is, explain how price and output are determined for a firm in a monopolistically competitive market in both the short run and the long run. So that's something to bear in mind, and that's the 15-mark question. Okay, so in this instance, what we're going to do is we're going to look at the mark scheme that was supplied by the exam board and give you some ideas as to how you might go about that question. So in the first instance, that first sentence, the roughly 18 billion sentence, and explaining that monopolistically competitive firms and oligopolies are seeking to differentiate their products to sell to consumers, is clearly going to be, to some degree, not necessarily influential, but you can certainly evidence that particular paragraph or couple of sentences in your answer, in your response, when you start to talk about particularly monopolistically competitive markets. Okay, because we've said that one of the things that a monopolistically competitive market is, you do have a slight amount of differentiation from some of your competitors, and clearly what you might choose to do is to emphasize that in your advertising and demonstrate that there is a reason why you might be able to charge a different price and produce at a different level of output because of that. Okay, so let's just take a look then at the next slide, which actually just breaks down a little bit to do with the mark scheme and the way in which you might attack this particular 15 marker. And it's something we will have a go at, but for the moment, let's just take a look at the response and the support that was supplied by the exam board for examiners to actually mark from. So the mark scheme guidance basically said areas that you should include in this question. And remember, let's just go back to the question again. So in this case, this is an explain question. The command word here is explaining something. So we've got to explain how price and output is determined for a firm in a monopolistically competitive market. So we know they're asking us what we know about monopolistically competitive markets, and also they're asking us to consider that both in the short run and the long run. Okay, now we might need to make some assumptions as to the type of organisation and the type of objective that organisation might have, but in this instance, probably focusing on profit maximisation might be a good option. But let's just take a look at some of the support that was provided by the exam board. So suggestions for areas of discussion include the features of a monopolistically competitive market, including the characteristics of the market. We've got differentiated products, we've got spare capacity, we've got some influence over price, we've got perfect or good information, and we've got no barriers to entry or exit with many producers and consumers. So clearly explaining what you know and what you understand a monopolistically competitive market to be like, and the characteristics it would have, clearly you're going to get some guidance, or you're going to get some value for including that. because clearly that demonstrates that you understand that particular part of market structure as far as monopolistically competitive firms are concerned. So that's the first area. Second, could be that pricing decisions, because remember we've been asked to look at both pricing decisions and output decisions, they are going to be made independently of rival strategies, because in this instance we've obviously got the opportunity to differentiate ourselves in some way. The other thing that we could consider is, in the short run, we could look at the short run analysis explaining how firms set quantity by profit maximizing. So again, we could qualify what we're saying by saying, in this instance, we're assuming that the firm is a profit maximizer, and that the price that they charge can be worked out from the average revenue curve. Okay, so assuming that we know it's a downward sloping demand curve, because in this instance we can actually influence price to some degree. And that clearly we can lead on to talking about the degree of abnormal profit that we can achieve, assuming that our average cost is lower than our average revenue. Okay, so that would be a way of approaching it, certainly in the short run. If we then look at what might happen in the long run, as we said before, and this really is almost just an explanation of how you might apply those two diagrams that we did in the last narrated PowerPoint to this particular question. Okay, so in the long run, rival firms have an opportunity to enter the market because there are no barriers to entry. And that clearly is going to mean that the existing firm's demand curve will shift to the left, as we showed with that pivot and shift, if you remember, in the long run diagram that we looked at previously. And if the firm is still attempting to profit maximize, that's going to be at a lower level of output, where abnormal profits are going to be competed away, and we are going to be in a normal profit situation where essentially average cost and average revenue are equal. Okay, so you can see in that scenario clearly the two diagrams that we talked about, both short run and long run, in a monopolistically competitive market where we are profit maximizing, could be used and definitely be explained to demonstrate the point. So that would be a good way of applying what we've talked about and giving some real substance to your answers. So that's a very quick guide to the mark scheme for that particular question. Okay. Now what we will do at a later stage, probably when we return back to school face to face, is we'll take a look at that question together and have a go at it in class. Okay, so that's something to bear in mind. But have a look at it, give it some thought, think about how you might structure that process, that answer, if you like, and using the mark scheme, maybe put a plan of action together, maybe also practice the diagrams that we've done recently as well. Okay, so we keep mentioning barriers to entry. So one of the things that I want to do is just touch on that in a bit more detail and explain a little bit more about both barriers to entry and barriers to exit. Okay, now it's a recurring theme in any form of market structure, whether we have high barriers to entry or low barriers to entry, or high barriers to exit or low barriers to exit, will have an influence on the way in which markets behave effectively. Now what we're going to do first is look at barriers to entry, and then we'll look at barriers to exit. So without further ado, we'll move on. We'll look at a definition and explaining exactly what barriers to entry are. Okay, so Joseph Stigler, very famous economist, defined the barriers to entry as the following. So it's basically a cost of producing at some stage or every rate of output, at some or every rate of output, which must be borne by a firm which seeks to enter an industry, but it's not borne by firms already in the industry. So those that are already in the industry don't have to use this chip, if you like, to get to become part of the game. That's a bit of a weird description there, but effectively, those businesses that are already in the industry do not have this extra cost. And clearly, in some cases, if that extra cost, or there is a cost to enter the market, then that in some cases might put some firms off if the amount of cost or the the things that you need to do to get into that market are punitively expensive, then clearly that will put some people off. Bain, another of our economic friends, identified there being 4 different types of barrier. One is economies of scale, which is something that we have looked at and will keep coming back to. So economies of scale being one, absolute cost advantages would be another. So if an organisation has got a patent or has got pretty much a monopoly on the ownership of certain raw materials, that's going to be another reason for a barrier to entry. Product differentiation advantages could also be a barrier to entry. If a brand is so strong and it has such a strong market presence and high level of market share and high levels of consumer loyalty, that might mean that actually we're not even going to consider moving into that particular market because of the power of that particular organization. So if we take in the instance of, let's say we were a mobile phone producer, a new mobile phone producer, new kid on the block, given the differentiation advantages that the likes of Apple and Samsung and the massive market power that they've got, might well mean that we actually think it's probably not a good idea. We might go and sell our idea or our innovation to one of those big brands, but are we really going to be able to compete? Well, in the first instance, that you might consider that there would be some very high barriers to entry. So you'd either need a very big backer with very, very deep pockets in order that you could compete on their on the same level as their brands, and whether that would be a worthwhile investment for somebody is a bit questionable, to be fair. The next thing could be capital requirements. Okay, so you might have very high fixed or very high sunk costs, which are irrecoverable. So, for instance, let's take the example of the mobile phone industry. If we decided we were, as a new kid on the block, decided we were going to start to advertise and try and compete with the likes of Samsung and Apple and Huawei, for instance, there would be huge sunk costs in terms of our advertising. In order to compete with them and get our brand out there, we would have to spend an inordinate amount of millions and millions of pounds or dollars to get some share of voice, and clearly we're not going to get that advertising money back at any stage. So that's something to bear in mind. So high levels of fixed or sunk costs are also considered to be barriers to entry into a market. So some further examples, and if you take a look on page 36, so page 35 in your booklet, in your yellow booklet, we've actually gone through the first part, looked at some examples of the different types of barrier, the definition of what barrier to entry is, and also there's a couple of examples for you to tasks to complete on page 35, listing the barriers to entry of setting up a new airline business for as an example. Okay, and the second question is give examples of industries with high startup costs or high sunk costs, and you can do a little bit of research on that just to get familiar with it, and also to be able to evidence if you get a question on contestable markets or on high levels of barrier to entry or high sunk costs, then having some examples at your fingertips is going to be really helpful. So that's something that's definitely worth considering and doing. Okay, so on page 36, we've got not only have you got the list of the examples of barriers to entry on this narrated PowerPoint, but there are also some explanations as to what these barriers to entry are, and that hopefully is going to be a good summary for you to be able to explain. Okay, so we've got patents as an example. A patent basically is where a business has actually has invented something and has actually patented that particular invention so that nobody can copy it for a period of time. Generally speaking, when you're inventing something and you patent something, it's because it's been a very expensive process and you've created something that's completely unique, and you don't want anybody to be able to copy that for a period of time. You pay for the patent, but actually it means that nobody can copy it, and if they do choose to copy it, then clearly you have the opportunity to sue them or to tell them they've got to stop, basically. So that could be a barrier to entry. A license or licenses or specific qualifications, again, could be a barrier to entry into a market. Ownership or control of factors of production, again, if you've got those, if you've got superior links with the raw materials that you're going to need to be using, so land, labour, capital, or enterprise, then maybe that's going to mean that you are going to have an advantage, and those people who are considering coming into your market are going to have a barrier to actually try to get over before that. In some cases, you get what's called entry limit pricing, and again, this is explained in a bit more detail on page 36 for you. But that's basically where businesses that are operating in the market might choose to limit other people coming into the market by, in some cases, creating sales prices that are at a very low level. Might even, in some cases, be below cost price, just to keep people from coming into the market. So when you do your due diligence and move into a new market, you might say, well, okay, who's charging what for a particular product? And think, well, actually, can we do this and make a profit? And in some cases, the prices that are being charged by some of the organisations actually in the existing market might actually prove to you, well, actually, it's not worth it because we're not going to be able to make enough profit on it. So that's another issue. Okay. Other things could be cost advantages. Back to economies of scale, really, in one sense, where you've got lower cost per unit. Now, if the organisations that exist within that market have gone through the process of getting these cost advantages, whether they're technical, managerial, and achieved the lowest cost per unit of production, then that might be another reason why you might choose to not move into a market. Advertising and marketing strength, it would be another reason. Again, we talked about that example, given the mobile phone industry as the example, where if you've got high levels of advertising and marketing expenditure and highly differentiated offers within a market that you really can't compete with, then that creates, or don't feel you can compete with, that is going to create another barrier to entry. The next one, there's a couple more, research and development expenditure. So in this instance, again, if you've got a very high level of research and development expenditure within an industry, and there's lots of innovation and lots of competition, that might be another reason why, if you've got a significant amount of investment into research and development, not all businesses are going to afford to do that. And so in some instances, that's probably going to mean that those businesses that have gone through that process will have structural and cost benefits that you're not going to be able to compete with, and then that could be another reason why you might not choose to go into that particular market. Mentioned sunk costs. Okay, so that's where you've got in some instances the costs that you have to sort of commit to in order to enter a market, but in some instances that means that then you're not going to get those, they're not recoverable costs, like the advertising example I gave earlier. And again, if you've got high levels of irrecoverable costs, that becomes a bigger risk decision, doesn't it, to say, well, we're going to move into this market. Okay, so that could be another reason why people would choose not to go into that market. Okay, the last one that's mentioned there is international trade restrictions, and that again could be considered to be a barrier. Let's say if we've got a market that has tariffs being applied to it, or some protectionist policies going on, which might mean that you're not going to be able to be internationally competitive in that particular area, and that would be another reason why, in some cases, you would choose not to enter a market. Okay, now we've said that in some instances, in some market structures, there are very low barriers to entry. So in the example that we gave of perfect competition and to some degree monopolistic competition, a lot of these things aren't going to exist at a point or at a very high point such that is going to stop people from moving into the market. However, when we start to look at oligopolies and monopolies, and also whether a market is contestable, i.e. we're able to contest and actually compete in that particular market, in that case, barriers to entry are going to be something that we are going to keep coming back to. So it's important that you understand some of those principles. Okay, now I've gone through that reasonably quickly, but I would say that there are some quite nice explanations and definitions, if you like, based on what I've talked about here on page 36 in your booklet. Okay, so the next thing I want you to take a look at, and this is a group task that possibly we might be able to come back to and take a look at when we come back face to face, and that's to look at there's four different markets. There's the bus market, there's the razors market, there's the soft drinks market, and there's retail supermarkets. And I want you to consider what the barriers to entry might be in each of those different markets. This might need a little bit of research. You could do it as a bit of a group research activity. So what the barriers might be, and then also the impact on the industry structure and also consumers, because like we said, to some degree, if there are high barriers to entry or relatively low barriers to entry, then that might influence the type of industry structure that might work around that particular market, and also the types of consumers that we're talking about too. Okay, so there's another activity there for you on page 37 to consider, and again, that's something that we might take a look at in a bit more detail when we return to face-to-face lessons, and but that's on page 36 and 37, sorry. So let's take a look at the next thing then. So that's your barriers to entry. We're now going to look at barriers to exit then. Okay, so we've got in this case three examples. Okay, we mentioned sunk costs. Okay, sunk costs is one of the big barriers to exit of a market. Okay, so if we've got high levels of sunk cost, okay, that's where costs are incurred that can't be recovered should we choose to leave the market. So the losses that we might incur from selling off assets. Let's say we bought a load of assets and then actually, because we weren't able to use them in the way that we were hoping to, we then have to end up selling them, and we might end up making a loss on that. Clearly, spending on a large advertising campaign to get the awareness out there, if we're in a very highly competitive market, then clearly that's not money that we're going to ever get back from to our organisation. Okay, unless we start achieving significant sales based on that advertising campaign. So if we choose to come out of the market, and if we've invested a serious amount of money in terms of advertising and trying to get some presence in that market, that could be an issue that might stop us from exiting the market. Okay. Other things could include, again, if we're going to have to shut down, if we decided that we've got to shut down point where we're not going to carry on, or we're going to move our resources to another marketplace or into another market sector, we might have redundancy costs. We could have some penalty costs from ending agreements earlier than expected. They are all reasons why we might choose not to actually exit a market. Okay, and you might think, well, that seems a bit hard, but in some cases, that might be another reason why we might choose to stay within a market, okay, rather than to move out. Okay, the other thing is bearing in mind the other issues around coming out of a market. So if you go in with a much vaunted launch into a market and actually you end up not doing quite so well, that could cause all sorts of damage to your brand. So there could be a loss of faith in the brand and the management team, because maybe the decisions that were made weren't quite where they should have been. Okay, so if we're thinking about this as a principle then, and trying to summarize that, if you like, what that means, if you've got high levels of sunk cost, a market is going to tend to become less contestable. Okay, because if you've got high sunk costs that include exit costs, they're going to act to a barrier as a barrier to entry for new firms, as well as a barrier to exit as well in the end. So if you commit to and then give it a crack and it doesn't quite work out, then there is an argument to say that you're going to have you're going to be hit twice essentially. So your exit costs are clearly going to be very high, but also you might, if you've actually done your due diligence and thought of the whole what if scenarios, okay, you might think, well, actually, if this doesn't work, we're going to have some serious amount of sunk costs that we're not going to be able to recover, and that could also become a barrier to entry, not just a barrier to exit. Okay, so they sort of sit hand in hand, really. Okay. So hopefully that explains the principles of it. Again, the definitions are on pages 35 through to 38, and the examples should give some clarity too. And in addition to that, there's quite a nice extension reading article on page 38 and 39, which looks specifically at barriers to entry, exit, and mobility. It's come straight from The Economist back in 2009, but again, it's quite a nice explanation of, in this case, how barriers to entry and economies of scale can actually be affected or affect a market, and in some cases governments can get involved in the erection of barriers, and it's quite a nice summary and gives some quite nice examples that you can refer to, again, on any answers, any questions that you might get posed, which talk about some of the issues around barriers to entry. Now, one of the things that we'll look at in a bit more detail is when we start to look at other market structures, which we've not looked at yet, but we will do in the next booklet, which are oligopoly and monopoly. In that instance, we've got relatively high barriers to entry, okay, because again, when it won't go into too much detail now, we'll explain what the differences are in terms of oligopoly and monopoly, and also how both of those have significant barriers to entry to actually enter into one of those markets. Okay, so that finishes off booklet number 5A, and the next thing we'll start to look at in a bit more detail, probably not in narrated PowerPoint form, but more likely to be face-to-face form, will be the market structure of oligopoly and then also monopoly. So thanks for listening once more, and I hope you enjoyed this series of narrated PowerPoints, and I'll talk soon.